Good morning, good afternoon, good evening to wherever you are, and thank you very much for joining us on this webinar. My name is Simon Perham. I am Head of Investor Outreach for Europe at Carbon Tracker. Many of you will know Carbon Tracker, but for those who don't, Carbon Tracker is a not-for-profit independent research house analysing the effects of climate change on the financial markets and its stakeholders. We're here to take you through the session. Session title is How Can You, the investor or a stakeholder, evaluate and steer a company's company management's transition readiness by analysing and enforcing an effective transition remuneration incentive strategy. To put some perspective on it, many of you perhaps have read the emails that I sent out, but we have this very big new system coming in at speed that is effectively going to take quite sizable market share out of the demand for oil, gas and coal over the next 10, 11 years. And in order for you, the investor, to protect your capital that you've got invested in these companies, they need to be ready. We often say in Carbon Tracker, climate might have started the transition, but economics will finish it. So really to start off with, I think we'll get straight into the session. And first up, if I can ask Maeve O'Connor, the author of Crude Intentions, to run through the key points. The goal here today is to give you practical ideas and advice and suggestions on how you can implement a successful stewardship strategy to help your investment transition successfully. So if I leave the floor to May, in terms of questions and answers, please put them in to the Q&A box. We've got some fantastic panelists, and I will introduce them later, and they're here to help you. So please, with your name, put the questions in, and over to you, Maeve.
Thanks, Simon. Those slides are up okay, are they?
They are indeed.
Wonderful, okay. Well, by way of introduction, my name is Maeve O'Connor, and I'm an associate analyst on Carbon Tracker's oil, gas and mining team. I joined Carbon Tracker in February, and since then I've authored both Crude Intentions and a report on company emissions targets, absolute impact. So thank you all for joining today, and thank you for your time this afternoon. I'm going to give a brief overview of the kind of core principles and findings of Crude Intentions before we jump into a panel discussion. So Crude Intentions is the fourth report that we've done in a series on oil and gas executive remuneration. And as Simon alluded to in his introduction, all of our research rests on a pretty straightforward principle, and that is that the energy transition is inevitable. The new renewables-based system is cleaner, it's cheaper, and it's more secure than its fossil counterpart. And putting even climate considerations aside, a clean energy system is now recognised as auspicious both by markets and governments, both of whose actions are now accelerating a falling demand for fossil fuels. This, of course, has drastic consequences for oil and gas companies, as their traditional business models will soon be obsolete. In response to these changing circumstances, companies have several kind of strategic options for responses that we see. They could pursue a managed wind down of their fossil producing assets and return values to shareholders. Or they could diversify into renewables or other non-energy sectors that are viable in a low carbon world. We are seeing kind of some of the European companies in particular announce their intentions to move in this direction. Or indeed, they could stick to their guns and kind of continue to produce fossil fuels, even in the face of falling demand. But regardless of what direction company chooses, it's imperative that shareholder interests are really protected. And at Carbon Tracker, the goal of all of our research is to equip investors with both the information and the tools they need to make shrewd investment decisions and to protect their capital as companies navigate the energy transition. So among these tools, and one that we'll focus on today, are remuneration policies. So this report, as I mentioned, focuses specifically on policies as they appear in oil and gas companies. But I think really the ideas and the first principles of the analysis can be applied to any sector and facing risks from the energy transition. So moving on to remuneration policies, compensation really drives executive behaviour. It's human nature to act so as to maximise personal return. And we found that a large proportion, anywhere from kind of 2/3 to 3/4 of executive compensation in the industry is variable. That's the annual bonus or the LTIP, the long-term incentive plan. And those payouts are contingent on meeting certain performance targets. So in this report, we analyse these performance targets to see what strategic behaviour is being promoted by remuneration structures and whether or not this behaviour is exacerbating or mitigating company and shareholder exposure to transition risk. So for Crude Intentions, we analysed the compensation policies of 35 of the largest listed oil and gas companies, and we categorised their executive performance targets according to the behaviour that they promote. So are executives incentivised to chase production growth, or are they focused on shareholder value, or are they preparing for the transition? So that's the kind of framing that forms the basis of our categorization of performance targets. So we have 4 categories, the first being direct growth. So simple enough metrics that directly promote increased fossil production. These are production targets, reserve replacement ratios. Then we've got what we call indirect growth targets. So these may be influenced by other factors, but they implicitly encourage oil and gas volume growth. So these are kind of net income, EBITDA and free cash flow targets. Then we've got growth neutral metrics, which do not incentivize production growth and often do prioritize value for shareholders. These are your return on average capital employed, total shareholder returns. They can also include stuff like spills targets or safety targets. And then lastly, we have transition positive metrics. So these are the ones that promote resilience in the face of the energy transition. And they can include emissions reduction targets or targets around installed renewables capacities, CCS projects, etc. And before going into the results of the findings, I think it's worth dwelling a minute on what we think a kind of transition-proof oil and gas remuneration policy would look like. And there's a few trends that we spotted throughout the series of reports, some that have come to light more recently. Firstly, as we've said, they should prioritise value over volume growth. So value-based or growth-neutral targets help to mitigate shareholder exposure to transition risk, and they promote responsible corporate behaviour and prudent investment management by companies. On the other hand, direct and indirect growth targets could lead to executives kind of engaging in speculative hydrocarbon projects, which may not be required in a low-demand world, and so could well fail to meet IRR hurdles or expected returns. Then secondly, on emissions targets. Firstly, we would expect to see emissions targets included in the remuneration structure, but they should also be consistent with the company's wider emissions reduction targets. And we find that is often not the case. So for example, Eni as a company has quite an ambitious company-wide emissions reductions target, which is scopes 1, 2, and 3 reduction on an absolute basis. However, in its REM policy, its executives are being rewarded for a much kind of lesser target, which is a scopes 1 and 2 reduction on an intensity basis. So there's a kind of unalignment there between company goals and executive incentives. And I think with emissions, particularly short-term reductions are especially germane and important, given there's such a great degree of scrutiny on companies these days over both methane and CO2 emissions. And so failing to tackle emissions promptly and properly really exposes a company to potential litigation and to sanction risk. Then lastly, we see companies are starting to promote what they call low carbon growth segments a lot more. And these are areas seen to be potential revenue streams for a low carbon future. They often include renewables generation, they include the rollout of electric vehicles charging points, and maybe carbon capture and storage projects. However, we also notice that companies are starting to include fossil gas in these segments. So their remuneration policies include fossil gas production targets under the guise of them being low carbon. And we would really stress that fossil gas is still a fossil fuel, and so is exposed to transition risk and the falling demand for gas. The IEA in the 2020 WEO forecast the gas demand is going to start to plateau at the early 2030s. So it's really, we would really kind of encourage investors to be wary of companies that are packaging gas as a low carbon fuel. And so with that being said, I think we can jump into the results. So this is a breakdown of the company's 2021 target variable pay with conditions by metric type. So we've calculated the weight that each metric category holds in determining the payout. And so from left to right, we have transition positive in the blue, grey there is growth neutral, yellow is indirect, and red is direct growth. And these are the results for Europe and Asia Pacific. So the top two kind of worst performers, I suppose you could say, are both Australian companies. You've got Woodside and Santos, with quite a high proportion of direct growth targets. But I think really what the most striking findings from this graph are that a lot of the European majors who are very vocal in their plans to combat the energy transition and who are have quite ambitious emissions reductions targets are still directly or indirectly promoting production growth. Especially in, say, BP's case, they've pledged to cut oil production from 2030, and yet their executives are being incentivized to grow production in 2021. Similarly, Eni, Total and Shell all have quite ambitious climate targets, but they still have pretty significant portions of direct and indirect growth targets. That being said, transition positive metrics are becoming more prevalent, and that's kind of a trend we've seen over the last few years in Europe, is a growth of these kind of targets, which is a positive movement because it shows that companies like Total and Eni, who have kind of ambitions to become integrated energy companies, are aligning their executive incentives with those ambitions. Moving on to North America. I guess these results are kind of broadly in line with what you'd expect from the North American oil and gas companies. Generally speaking, they've been much less adaptive to the energy transition, and we've seen them be quite vocal about their intent to continue to produce more oil and gas despite falling demand. And they've generally kind of been behind the curve of emissions reduction and emissions management. So you can see the transition positive metrics are much less prevalent. Exxon is kind of the exception, and that's largely due to Exxon's low carbon solutions program, which depends quite heavily on carbon capture. So they've got a few performance targets measured against progress on CCS projects. But largely speaking, they have yet to, or transition positive metrics have yet to make kind of a dent in many companies in North America. Whereas we see that direct growth targets are still quite common, and combined with indirect growth targets, they'd still make up quite a significant portion of some of these companies' remuneration policies. And again, kind of generally speaking, I think it's broadly reflective of the inertia that the North American industry has displayed over the last few years. And so to leave you with a few takeaways, we would say that remuneration policies are a means for investors to protect their interests in the face of the energy transition. We think that oil and gas executive pay should reflect a company's adoption strategy. And we would encourage shareholders to challenge direct growth metrics and to push for efficiency over obsolete. So to move away from volumes targets and towards maybe cost per barrel or returns per barrel targets. And then to dig into low carbon growth metrics to ensure that they're not concealing intentions to grow fossil gas. And lastly, then to ensure that emissions targets are accurately reflected in remuneration policies and that they're as ambitious as the company's own targets. Lastly, then, this analysis has focused on oil and gas companies, but again, we think it can serve as a template for all industries that are reckoning with the implications of the energy transition. And I think I'll leave it there and welcome any questions. And I'm looking forward to the panel discussion. Thank you.
Mate, brilliant. Thank you very much for that succinct run through. Just as a reminder, you know, we're here, or I'm here to represent, you know, the audience. I'm here to be the voice of you, the viewer, and we want to have a great discussion here. We want to give you practical advice, some ideas of how our panelists have overcome perhaps some of the things that you're facing right now. But we can't do this without you asking questions. So please put them in there. The Carbon Tracker spends an awful lot of time. You'll see one part of Carbon Tracker, which is the human face of Carbon Tracker. Perhaps that's the bit you know, but 90%, 95% of the company is people like Maeve who sit in Chatham House Rule meetings with the people really in the front line, trying to solve the problems that you probably are sitting with as well. And it's important that we have a couple of experts here. That is a great opportunity for you to ask those questions. So really, let's move on. Let's introduce our fabulous panelists. Rosanna, may I ask you to give a quick briefing of why people should be listening to you? What's your expertise?
My expertise is CEO pay, particularly within the USA markets. I had one of those way leads into way careers. I spent some time at Investor Responsibility Research Center and then at ISS on the comp team. And I'm now with As You Sow. And I've got a very long experience with compensation, a much shorter experience with climate, but just delighted to be able to bring my nerdy comp side onto what is a real huge problem. I mean, income inequality is also very important to me, but if we can use the lever of compensation to improve things on climate, that would be ideal.
Piers, what about you? Why should we listen to you, or why should the viewers listen to you?
Yeah, well, thank you, Simon. What an introduction. I'll probably disclaim that in saying there's no in advance reason to listen to me. I should only be listened to on the basis of what comes out of my mouth at any given moment. So, I run the global investment stewardship function at Franklin Templeton. Before that, I worked on active ownership and investment stewardship at CCLA Investment Management. And throughout this time, both at CLA and at Franklin Templeton, we've been really focused on how you can drive transition through active ownership as the cornerstone of solving some of these issues that are creating massive externalities in capital markets around sustainability. And because in order to achieve a lot of progress on these goals such as climate change or income inequality or social issues, it's not going to need small parts of the capital market system to be doing all of the work. And indeed, it's not just going to need the capital market system to do all the work. The public market should be involved. And so what we've really focused on is, well, how can we use all of the levers for change that we have available to us as investors across as wide a scope of assets as possible? And so what that means in practice, and for things like this conversation, is it really means, well, how can we make this relevant to not just how is this relevant not just to the investor with strong values regarding sustainability, but how is this relevant to the value that all investors and all companies are pursuing? And through that lens, we can then take what the really meaningful points are that really express the why for capital markets and drive transition across a wider scope as possible. So that's really what I do in my approach. But thank you for this excellent report, and I'm looking forward to the discussion.
Great, thanks, Piers. So, look, what I think the first basic question, if I may, and we've got some great questions coming through, and we'll get to those in a moment, because that's what we're going to prioritise. But what do you see as the primary role of the remuneration committee, in how it can shape the transition strategy of a company? And when you're looking at the makeup of a remuneration committee, what should you be looking for in the structure and the experience of the people that are actually making up that, and what are the instant red flags that you would immediately shy away from when looking at this committee? Rosanna, why don't you have a crack at that, because you look the most ready to go.
That might be a misleading impression, but I'm happy to give it a shot. So in the US, it's the compensation committee generally. And I know a lot of shareholders who look at this as, well, first of all, the compensation committee's job is to set compensation, but really it's to incentivize, a CEO and the other executives to move towards the company's long-term strategy. And it's actually one of the committees that's sort of most, you can see what they're doing, and it helps you evaluate sort of the board independence in the larger sense. I know a lot of people who look very carefully at pay, not necessarily for climate reasons, but because it can be a red flag for a board that is too acquiescent to the CEO, too bound to the CEO's situation. So there's it's probably the committee that gives you perhaps the most insight into the company. So you want people who have expertise. You ideally want them to have someone who knows all the stuff, and sometimes a separate compensation consultant can be useful, because if there's a compensation consultant that's representing the CEO, that consultant's job is more about getting the CEO as much as I can, and it sometimes helps to have another a person on the side of the directors when you want to keep this all as friendly as possible, but should not be paying in excess. And yes, I mean the independence is hard to underestimate. I think that's a huge component.
Piers, what about you? Do you think just one further question to add to the mix of the 6 I've already given you to remember? Do you think, Rosanna was talking about, experience. Do you think there needs to be somebody on the remuneration committee that has, a good set of climate experience? Or do you think that most of it can be done by, common sense and a little bit of, background reading?
Yeah. Okay. Well, I've now got I should have really been writing notes on what all these questions are, but I can talk to that first one. I think it's a really solid principle. I think it's very clear to us that really a remuneration committee or remuneration plan should be tailored to the specific circumstance of the company. Every company is different and will have slightly different roles to play in the transition. Sectors are by no means homogenous. I mean, certainly that's the basis that active management is founded on, so I would be remiss not to back that up. And so having that, having a mix of independence, a wide range of views, but coupled with some specific experience that's going to allow the remuneration committee to meet its core purpose, I think that's incredibly important. And I think if a remuneration committee didn't represent industry experience in any way, that would be a little bit of a red flag. But and in terms of what the wider context that we view, or that I view the remuneration committees to operate in, is really as an investor, we're looking for remuneration plans to be cohesive, transparent, logical, and really in total just ensuring that the mix of incentives that are acting on the executive committee are balanced and they're aligned with what the shareholders want. And the committee is really the main mechanism that we can engage with to deliver that. And they're also responsible for not only making their own judgments and assessments of what is best for the company and the shareholders in the remuneration, but they're also responsible for sort of herding the cats and getting the views of all the beneficial owners and the shareholders. And I use the herding cats metaphor very deliberately, because engaging with such a wide base of investors, if you're a global company with a highly diversified shareholder base, is by no small task. And there's a lot of different incentives to represent there. And there's also a bunch of very careful planning that needs to go on to make these dialogues with shareholders meaningful without inadvertently bringing shareholders inside or disseminating non-public information. And there's been lots of really interesting ways that companies have addressed that. There's been a particular experience that I've had where, we were solicited for feedback on a range of plans with no indication of whether any of them would have been chosen, but there was just a mix of, well, what do you think about each of these 10, that allowed them to get feedback on a wide range of proposals without necessarily giving any indication, which I thought was a particularly interesting approach. But so whilst these goals of being cohesive, transparent, and logical with balanced incentives sounds really simple, it's actually an incredibly complicated endeavor. And so I think really, for us, a good remuneration committee is one that has the right levels of experience, skill, and diversity to try and tick all of those goals off, and also really reflects the makeup of its shareholders. So not just the makeup or the operating jurisdiction of the company.
Yeah, no, great, Piers. Thanks for that. And I think plenty to dig into there. But what I'd like to do is, we've got a couple of great questions from our viewers here. Karina Litvak, I hope I've pronounced that right, has got a couple of questions, but I'd like to start off with her first one, bringing Maeve back into the conversation, where Karina's saying she's surprised by your preference, or our preference, Maeve, for intensity over absolute reductions, insofar as companies deliberately take a dilution approach. It continues to grow. It continues to grow fossil fuel production, but grows renewable faster. What's your thoughts on that?
Yeah, I think I know where that impression was picked up from. On my last slide, I said the shareholders should push for efficiency over absolutes, and that certainly wasn't referring to emissions reductions targets. Carbon Tracker certainly holds the opinion that absolute reduction targets are the kind of highest standard of emissions reductions. And certainly, as Karina says, that efficiency or intensity targets can be manipulated by adding renewables into the mix, etc. So for the efficiency over absolutes comment, that was really referring to production. So to push for cost per barrel metrics as opposed to absolute barrels per day metrics, shall we say.
Great.
Yeah, something I can add in there as well is what's very important to us in the net zero transition broadly is that it is an organised transition, and also energy and energy demand is right at the heart of socioeconomic development, and it's right at the heart of an orderly net zero transition that takes into account everything, or the socioeconomic development of the developing world, which is which has a much higher physical exposure to the impacts of climate change. And the reason that I mention all that is because investors and companies have a bit of a balancing act to do. And so whilst I would agree, I think the sooner that we can get to absolute net zero, the better, but predicated on its ability to be organized and in one that fundamentally puts people at its heart. And so I think an intensity metric is useful in that sense, because given that energy is such an unlocking factor in development, it's relevant to take that into consideration so that we can make sure that the transition is not only rapid and material, but is also organized.
Yeah, yeah, food for thought. And Karina goes on to ask a second question, which I think is quite interesting, because we talked about this yesterday about, you know, peers. Investment management houses often have hundreds, if not thousands, of holdings. The big ones certainly thousands across their strategies and their mandates. And peer grouping is important. And Karina goes on and asks, for companies that do decide to embark on a transformation process, this inevitably entails the business strategy on taking on a different shape with a different risk return profile. What do you, the panelists, think is the appropriate approach to redefining the peer groups that you put these companies in, given that most of the legacy peers are not doing this? Rosanna, do you want to have a stab at this, or?
Sure, happy to do that. I think peer groups have tended to be a crutch, and they've tended to be overused, and there's been a lot of harm done, and that's sort of well documented in the US market. Again, I'm not as familiar with the European markets. And I think where peer groups may make sense is in salary, right? That the what you're getting to come into the office every day piece. In terms of setting goals, I don't think that it's as critical to compare to peer groups. I mean, I'd like to see more independence and you know, I think if investors can be mindful of that, ISS and all those folks do a wonderful job of putting, you know, peers in context of size and money and stuff. Investors are going to have to take the step of putting it in context of strategy to some extent. But there are a lot of, you know, reasons to be concerned with CEO pay. And I don't think peer group alone is something to be weighed that heavily. I mean, again, and I'm wearing a different hat. When I talk about overpaid CEOs, that does matter more. But in the climate analysis, I think we need to keep a clear eye on what's important. And you know, again, if we're going for longer term compensation, longer term focus, what the peers are doing this short term should not be that critical.
Yeah, thanks, Rosanna. Piers, I know this is something, I mean, you know, Franklin Templeton has got zillions of holdings, and I know we were talking about this yesterday on our prep call. Perhaps you can sort of give some views about how you're going about, you know, this particular issue.
Yeah, so peer groups is something that, and I totally agree with the points Rosanna has raised as well, and peer groups are something that we are constantly talking to companies about their construction, and a lot of our engagement arguments sometimes get stuck on debating what they're doing is right with their peer group. And there's a couple of points that I think are really relevant to this, in that one of the ways, and this goes back to your earlier question about what a good remuneration committee looks like, but when we're really evaluating how good we think a remuneration committee is in their engagement with us, we would really measure them on their ability to justify both the quantum and the structure without referring to their peers. If they can make that justification on the basis of their fundamental business model, acknowledging the arguments that, you know, both us and them rely on, that every company is different, then that's a hallmark of good practice where they can do that. But having said that, I mean, peer groups, investors are always information hungry, and peer groups are part of that overall suite of information that we want to consume. So they are very useful. The other point as well to bring in here is a lot of what we're talking about in terms of good practice with specific regard to climate risk as within executive remuneration is around pushing forward transition metrics that as part of CEO pay, and again, this transition idea is so important because what we're pushing a lot of these companies to do, particularly in sectors with high levels of unabatable emissions, like the oil and gas sector, is we're asking them to fundamentally transition their business model. And so the peer group construction is really important because you may find that the company is transitioning between peer groups. And then if it's doing that, the peer group analysis becomes a lot more difficult. So, and there are some more fundamental questions within that as to, well, should you transition companies as they transition to a low carbon business model? Should you also transition their peer group? Or if everything is going according to plan, should their whole peer group be transitioning and should it remain constant? There's a lot of these and then at what point do you switch, or do you weight them between two in your own assessment as an investor, or in what you're asking the remuneration committee to rely on? So peer groups can be a really big topic that is also the only part of the remuneration discussion that is all to do with not the company. And so there's a lot of moving parts to manage. They are kind of useful and informative in the overall perception, but controlling for these externalities that are present, I think, is important. So I think it's the first kind of takeout from that is that it's important not to overstate their significance, and that we're actually fundamentally seeking these plans to be justifiable without them. And also we need to make sure that we're not creating a strange balance of incentives if on one hand we're asking for transition, and on the other hand we're asking for them to be in line with their peers. So I think those are the two main points that we're trying to address. But it's certainly information that we consume in our decisions.
Yeah, thanks very much, Piers. I'm going to slow things down a little bit here, if I may, and go back to one of the questions that we discussed earlier. And then I've got a couple of real killer questions that I'm going to zap you with when you've been lulled into a full sense of security. The remuneration policy should seek to align the interests of the directors with the shareholders. So what are the key basic components of a good remuneration policy, stripping back all the complexities and the individualities of companies, but going back to the core principles of a company, how a company is run, and the shared goals that all companies have. And perhaps I'd like Rosanna to start this off, and I'm going to give a very shameless plug to your team's Pay for Climate Performance report, which I think you wrote, or you finished and published in September of this year, and is available on the website. And I would recommend people to have a good look at that. But you talk about A grades to F grades, and you've kind of graded things. Perhaps a couple of key insights into what is an A grade and what is an F grade would be great.
Sure, happy to do that. First, I want to say Melissa Watson is the primary author. I worked very closely with her, but she did an amazing job, and because I didn't write it, I also feel like I can say that it's a phenomenal report. So we looked at a number of different key elements with sort of basically climate metrics and compensation disclosures both need to be transparent and measurable. So as we graded, we looked whether climate metrics were included in the long-term incentive plan, and I'll circle back to that. Whether payout amounts were set to incentive achievement of climate metrics, whether the climate-related targets were quantitative, and whether climate incentives were aligned with a 1.5 degree emission reduction. We did this sort of looking at this because more and more we are seeing almost a check the box element of, okay, we're linking climate to pay. And in ways that are often just almost absurd. We saw one company that they achieved these goals by holding an all staff meeting. So, again, not what we would consider sufficient. When we got to the grading, we had one B company, there were 4 C's, 17 D's, and 25 A's. 25 F's, sorry, no A's, 25 F's. Excel was the B, and I'll just talk a little bit about that. Excel Energy, they had a few best practice. First, it's a direct tie to quantitative emission reduction performance metric. You know, many companies, again, tied to subjective metrics or metrics that allowed the CEO to be paid for, you know, leadership or something like that, or perhaps metric achievement, but it could still be a situation where the company's emissions would continue to increase. So, and secondly, they tied the high quality climate metric to a substantial portion, I think it was 30% of the CEO's performance share units in the long-term incentive plan. That clearly signals sort of the importance. The annual plan, and again, I know it's a lot easier to add something to the annual plan, but what we're seeing is such complicated and situations where it is a question whether, you know, 5% of the 10% of the 5%, you know, it becomes just a vanishingly small percent. And the long term is really where most of the compensation is carried in our market. So we just, you know, and I know, so it's again, it's we think emissions reduction is likely to be non-linear for many companies. So I mean, ideally, we'd go even longer than 3 years, but it's certainly gets us closer than annual does.
You know, great. And I think bringing you in here, Piers, if I may, you know, we've talked, Rosanna talked about the metrics being a key component of a proper, you know, a decent remuneration strategy. I'll get there in the end. What metrics do you tend to rely on? You know, when you're sifting through these, have you decided on a, you know, a core, you know, top 5 that spans, you know, a wide range, or do you find that there's lots of nuances depending on what industry you know it's in?
Yeah, no, that's a great question, and probably more prescient than many would realize for Franklin Templeton's strategy. So it's probably a good, almost a slide by here to mention that actually, so not only is there a lot of diversity in the markets that we invest, but there's also a lot of diversity in each of our, we consist of around 14, 15 or so subsidiary investment managers that each specialize on their own strategy. And so what each manager may feel are the most relevant metrics may well change between them. So we'll sort of get that out there as I'm not speaking for what the checkbox approach is across the business. But so what good looks like in terms of what underlying metrics that maybe can change a lot. But I think the principles are still there. And not to repeat what Rosanna said too much, but I think the structure of the long-term incentive plan is the right place for a lot of the sustainability and climate risk to exist, because it matters in the magnitude and it matches the long-term outcome. And in terms of the short-term metrics, I think, you know, the short-term pay should really be aligned to short-term performance. And for the integration of climate risk metrics, I'm not 100% sure that TSR is all that useful. It carries in it a lot of exogeneity. There's a lot of different factors, and what we're really looking to achieve, and this is going back to the kind of one of the guiding principles points that I made earlier about ensuring balanced incentives, is that we really want the executives to be held to account for things that are in their influence. And so metrics fundamentally that carry a lot of model risk or carry a lot of exogeneity are not as helpful as they could be. And so more metrics like return on average capital employed, these kind of value-driven metrics are really, really interesting. They're very, very useful for us for actually making sure that the pay decisions are driven by what fundamentally is within the sphere of influence of the company and the executives. There's a few other metrics I think as well that are really important, because there's a lot of attention given to CEO pay here, but this is wider executive pay is such an important part of this. So CEO and senior management pay similarity, so going beyond the exec-co as well, I think is quite important in the pay design. And again, consistency down to the median employee, so total quantum relative to median employee pay is something that's really important, particularly now with this with a very just focus on the cost of living crisis. So ensuring that these overall quantums aren't outrunning the fundamental picture of the company and its customers as well. And in terms of specific sustain, and that kind of speaks a little bit to the financial metrics that are really important, because so much of our transition arguments as a business are going around that actually climate risk and also climate related externalities are fundamentally important to the financials. So firstly, these financials should match what we're asking for on the climate side, but in terms of specific climate related metrics, there are some which I think will vary a lot, and they'll not only vary on the basis of what management want, but also on the basis of what investors are willing to tolerate. And this is why the Remco engagement with its shareholders is so important, because in transition metrics, and I think some of the leadership of the oil and gas sector is putting up to 40% of the total pay on transition. There are metrics like gigawatt renewables, either generation or consumption or electrification related metrics, things like long data renewables within the long-term incentive plan to determine the total reward. And so on one hand, we're very supportive of those because they align the long-term interests of the shareholders, because we're focused on the climate transition with company management. And also they make the executive incentive plans resilient against short-term market movements, which again is so important to giving them the license from shareholders to drive through what in many cases will be a very capital intensive transition. So they're very, very important from that perspective. But I think the company has to go back to the shareholders and say, well, how much of this are investors happy with? Is there like an acceptable range of return on invested capital that you want to maintain if we are putting huge parts of our executive compensation plan on long date renewables? And so it's got to be a bit of a collaborative dialogue, because for different companies with different shareholder bases, there will be different levels of exposure to that they will accept. And so it's most important here that we get transition plans that are implemented, not just sterling plans that are written. And so it's treading that balance between getting something that is driving the right transition, it is allowing executives to make long-term decisions irrespective of short-term market movements, but then is also getting past the shareholders and getting implemented, and then seeing it in fruition.
Yeah, and just following on from that, a quick yes or no really answer here. We've got an anonymous attendee asking, is more regulation needed to close the gap between emission goals and remuneration? Yes, and a one sentence answer afterwards, or no, Rosanna.
I was going to go with one word, which is yes.
Okay. Would you agree, Piers? Or do you think it's about time that the asset managers actually pull their finger out?
Oh,
it's not an either or. It's not an either or.
No, I mean, or do you?
Well, I can return your difficult question with a difficult answer and put my economist hat on and say it depends, right? Because yes, if it's good regulation, and no, if it's bad. And investors need to be really clear, and this goes well beyond pay. Investors need to be really clear what they think will work to regulators so that it is good. So we've all got a bit of a role to play. I think if I had to pick one, yes. But investors also need to take responsibility for making it very, very clear to policymakers and regulators what it is that they think is going to work.
And a follow-up question. Okay, going back to we can get more regulation in there, but another question surrounding this from Enrico, who we know very well. Are restrictive share plans, versus performance shares better suited for a company that is transforming? Any views on that at all?
It depends. I think we've been sort of talking about, you could do performance share plans that were based on emissions reductions. For example, you could change the performance metric in those share plans. I appreciate the restricted share plans in general. I think largely investors in the US are going to be very negative towards those, unless they have some adjusted criteria. But you can get around some of that too. I mean, I think a longer term restricted share plan is probably better than a shorter term. And you know, especially if you articulate, we expect to be in a large transition, you know, say it, tell your shareholders, we're not going to see this paying off immediately. It's really capital intensive in the beginning, but in the long term, we think this is better. And this is why we're focusing this way.
Piers, anything to add?
I mean, pretty much agreement. And to go back to my earlier point of ultimately, you know, you want plans that investors will accept. So setting that as the kind of guardrails in which we're operating. But I think so. RSUs are very helpful and should be part of it. Are one of the levers that we can pull. I would probably be on the side of restricted share plans, because yeah, no, I think it works, and to Rosanna's points as well. So not a huge amount of details about it, but.
Okay, I want to bring Maeve back into this, because at the beginning, just very briefly, and then I've got a couple of really cracking questions coming from the floor, you know, to finish off with, and we've got 8 minutes, so I want to crack through these. And Maeve, you mentioned in your report that the US seems to be behind the Europe in terms of this remuneration issue. You know, when you were doing your report, were there any sort of common characteristics of why that was? And perhaps we can bring Rosanna in as well, from her expertise on the US, over the legislation or the different ways that investors can approach this subject. But first of all, you know, anything clear in your analysis, Maeve, that made for why this geographical split seemed to be occurring, or it was just there and couldn't be explained?
Yeah, well, it's a good question. I mean, I think a lot of it comes down to the kind of corporate cultures of these companies. You know, the US in general, it's obviously a more kind of oil tolerant society at large, which I think kind of bleeds into their companies, and probably factors into their continued kind of insistence, or at least belief in the fossil system. And so that then manifests itself in company policy through, you know, quite lax emissions reductions targets. Some of these companies don't even cover scope 3 in their targets. You know, it's that kind of resistance that we see towards any sort of transition movement. And those then are reflected, I think, in the remuneration policies, like why, if the company isn't really accepting of the implications of the energy transition, then why would it, you know, naturally then feature into its CEO pay? I'm sure Rosanna could probably add on.
Yeah, anything to add, Rosanna?
I don't want to seem unpatriotic, but we're a mess right now. Politically divided, very open to misinformation. There's still people who deny climate change. And so moving much slower on that than we would like to see. Moving, though, I mean, I think we're far above where we were a few years ago. So, I mean, I think the unfortunate realities have started to open eyes that scientific papers did not. But yeah, and I mean, again, the scale of pay in the US is just a whole other level, and that in itself, I think, is extremely problematic. If I had a magic wand, I would change it.
Okay, so we're into the last 5 minutes, and I've got a couple of things here that I want to just quickly crack through. So, Piers, why don't you start? What I'd like to talk about here is that you've been to see a company, you're not satisfied with what you've learned. What should your strategy be to voice your concerns? If your concerns are ignored, what then? And then I've got a follow-up question from the audience that I want to bring in. So, Piers, how do investors voice their concerns?
Yeah, so I think the first thing is what constitutes to us the most effective form of investor engagement is long-term relationships with company management over time, because we don't really ever want to be in a position where a company is coming and saying, well, here's the plan, and it's the first time we've seen it, and it's right before the AGM, and we don't like it. We really like to be having long-term dialogues with companies so that our feedback and the feedback of all the shareholders and major shareholders is taken into account during the construction. And so I would hope we sort of, if everything is going right, would sort of never get there, because it would be this consistent dialogue over the course of the year where we would be constantly kind of negotiating and making our views known as to what we thought good would look like. And so by the time the plan comes out, at least, even if it's not everything we wanted, we can see the compromise in there. So I think that's the first piece. Obviously, if that doesn't, we are invested in around 12,000 different equity securities, individual equity issuers, I think. So we're obviously not going to have that relationship with all of them. And so if we do come and we see this plan as something we really don't like, I think the first piece of this puzzle is just engagement, and is making our views clear, and also not just coming to companies with solutions, but saying, look, this is the viable way that you can change this, that we think will make a difference. I think it's important to have collaborative approaches to these relationships, so you can show that you're really on their side, because ultimately we are. If that fails, you sort of proceed in the usual way. You vote against say on pay. You may hold the Remuneration Committee chair to account ultimately after that, and so on, and you proceed down that route. But every single step of that way, it should be very, very clear, constructive conversations to say, this is exactly what we're not happy with, and this is where we would like it to go, and very much be trying to approach it, taking into account the incentives from both sides to get maybe not the purest solution, but to get one that's fundamentally workable.
So,
in the time frame.
So, Rosanna, last question, because we're just coming up to the hour, and I think it's a good question. And okay, you're not happy. Piers is saying, they want to come up with some compromise, get the strategy in place. How do you challenge a remuneration committee's plans or a company's remuneration plans while not directly influencing a company's strategy, or not being overly prescriptive about the metrics? How do you avoid doing that by if you become overly prescriptive about the metrics and the weights being used in your assessments? How do you stop becoming overly bearing on a company?
Oh, look, our time is up.
Oh, we've just got enough time for this one.
It is tricky. It is tricky. I mean, that's why we tend to be very broad in terms of what we're saying. We're not saying sort of what kind of we're saying long-term instead of annual, for example, instead of saying here is the very specific thing. And the thing I want to add with this too is companies are talking to different shareholders and hearing different things. So I do think one of the unifying points of shareholders is, especially universal holders, pension funds, and all that sort of stuff, is a longer term focus. Is a longer term. It does not help me if the one company does extraordinarily well and society collapses. I'm here for the longer, broader support of a healthy retirement and so forth. I think that's one reason pension funds have taken some leadership here.
Great. Look, thank you very much for your time. Some great answers, some fabulous questions, and to those people, Jackie, Rachid, Malcolm, you know, we didn't get round to answering your questions. We've got your email. I'll be in touch with you to see whether we can get some answers across to you in due course. But I'd just like to thank you, the audience, the viewers, to come for joining us, for spending some time, your valuable time with us to debate these things. I'd like to big hand to our two panelists, Rosanna and Piers, for joining us. And Piers, I think you're in Barcelona at the moment, so have a good session there. And to Maeve for sparking this whole debate with her wonderful report. And if you do have any feedback and do want to get in touch, you know, my email is sperham at carbontracker.org. Always very, very happy and delighted to get feedback or comments or further questions, or just some advice on how to make these things better. But in the meantime, have a great rest of the day. And once again, thanks to Maeve, Rosanna, and Piers for joining us.
Thank you so much for the invitation.
Thank you, everyone.
Great conversation.
Thank you.
Great stuff. Bye-bye.